Thank you for coming in such numbers, braving the weather, braving the logistics that are associated with bad weather, so thank you very much. Actually, in fact, I don't know why I'm thanking you, because I made a market to my Investec colleagues earlier on. I'm a frustrated trader. I made a market of 320 to 340. In other words, people could go short of the number of people here at 320, people could go long at 340, and we've surpassed 340. And I have to say that my clever colleagues took my arm off at 340, so you've lost me money inadvertently, but I don't blame grudges. I was at the Morning Star Awards last week. In fact, I was the host of the Morning Star Awards in Cape Town, and the thing that struck me was the optimism amongst the great and the good of the asset management industry. The Morning Star Awards are the self-styled Oscars of the industry. And it was a fantastic evening, lots of pretty people, lots of clever people, but again, that optimism was there. The cynics, as Sanjeev mentioned, cynics among you. The cynics among you may say, well, it's maybe because the Kelvin Grove Club, which was hosting the event, had an open bar from 6:30 until 2:30, with a featured gin bar on the side as well, which was absolutely fantastic, and people were drinking deeply from the flowing bowl, as the saying goes. Anyway, it was a really good evening. I'd like to think the free alcohol was just a superficial sort of veneer on the evening, and in fact there was genuine optimism about what is going to happen in markets and in South Africa with an election coming up, etc. And that same sort of optimism was palpable in the previous taking stock presentations that we've been on, and it started last Monday in East London, went to Port Elizabeth, then Durban, then we've had 2 in Cape Town, we've had 1 this morning in Johannesburg, which was brilliantly attended. And again, there's a feeling of sort of bonhomie about markets. Maybe it's what my mother used to say, that sort of blitzkrieg spirit. She was a young woman in World War II, and the Luftwaffe tried to kill her, and therefore by association me, but everyone got together and sort of just said, well, it can't get much worse, let's just get on with it. And that's the feeling I am getting. So I've sort of changed my introduction to, we hope to bring you credible, cogent and compelling investment ideas for the next year and beyond, to we will do so, because having listened to the 2 fund managers, Sumesh Chetty, who's coming up later, and Clyde Rousseau, who was here this morning, I'm getting a distinct feeling that things are going to get better. 2018, it really wasn't great. It was summed up by an interview I did with a fund manager, not an Investec asset management fund manager, but a chap who was in the beleaguered sector of the JSE Securities Exchange, and I asked him about his fund, and then I said, just give me the facts now, what did you do? He said, we did well. We did well, he said. 4% better than the benchmark. I said, oh yeah, really, that's fantastic. Yes, we only lost 23%, he said. That was the listed property sector, and an extreme example, but it does tell you something about 2018, and I tried to sort of think about how I felt about 2018, and that to me is a bear market there. The volcano that you see on the screen there is a bear market, a dormant bear market, and this time last year I was sitting at the Sandton Sun, nervously making notes ahead of the taking stock presentation this time last year, and suddenly the Dow Jones was getting hit. I think it was a Facebook problem. Something happened anyway. The Dow Jones was going down 100 points here, 100 points there, eventually down 1,600 points before recovering a bit. But it's like a volcano. It's lying dormant, but you know it's there. And the bear market was there as well, and it showed its colours. It threw out a few rocks and some steam and some smoke, etc. And then it went a bit quiet, until, of course, January. There was a few ups and downs, but January was the real kicker. As Sanjeev said, the S&P 500 fell by nearly 9% during that month, and the bears were in control, and they gave us the V for victory sign. And the reason I put that up there, apart from the fact that I'm quite a big fan of Winston Churchill, is that if you look at the next slide, you'll see that the V is incredibly important and reinforces what Sanjeev said about staying in the market, not getting out, not trying to be clever, not trying to time the market, because if you time the market, you would have said, in the first part of December, thank goodness I'm underinvested or out of the market. I can now go to my smart home in Mauritius and come back and start rebuilding again. Because when you get that sort of fall, it normally takes a while for the thing to lick its wounds and get back. But it didn't do that, and you would have been in trouble. Now, what we're going to do is play you a short video. There's a couple of specimens at the beginning of the video that will probably make you annoyed, but the video ends well, and while the video is on, Sumesh Chetty is going to join me on stage.
We will build a great wall along the southern border. It'll be 25% for steel, it'll be 10% for aluminum. And it'll be for a long period of time.
Thank you, Mr. Speaker. The results of tonight's vote is the greatest defeat for a government since the 1920s in this House. This is a catastrophic defeat for this government. After 2 years of failed negotiations, the House of Commons has delivered its verdict on her Brexit deal.
Told that will make this economy going behind. I want to assure you people and assure the country the economy is now on.
I told you it was a happy ending. We'll get on to the American stuff and the international stuff if we have time, Sumesh. Welcome, by the way. Especially as the Democrats are now circling Mr. Trump. I mean, I can almost smell the impeachment. But let's talk about the small matter of elections and ESCOM. You have to factor these things in. Some fund managers are locked away in dark rooms and are not allowed to watch television, not allowed to reference the internet or anything, and they don't care. I've had so many interviews with them and they say, we don't care about macro, we don't know what macro is, we can't predict macro, we're just looking at valuations. You're not quite like that.
No, not quite like that, Lindsay. So it's easy to get caught up in valuations. I appreciate where people are coming from. Macro is incredibly unforecastable. And it's amazing how things have even changed in the last week, and we'll get to that now. But you can't build a portfolio without being cognizant of the risk. Because there's this great saying, the market can remain irrational longer than you can remain solvent. And ultimately what that means is if you abide by valuations alone, you're assuming rationality. And of course the market's driven by fear and greed. So we are very aware of what's going on. We don't build portfolios around it, but very, very aware of the risks that exist in the environment.
How big is the election for us as individuals, as South Africans, and also in the eyes of the world?
I think in the eyes of the world, the election's a bit of a tipping point. But frustratingly, I think the world also feels that they've been here before. In fact, this time last year, with the Ramaphosa that we all experienced, and unfortunately, that faded rather quickly because people realized that there are more problems. There's more of a diversion within the ruling party than they had expected. But ultimately what it means for us is that the population is very aware that Cyril Ramaphosa needs the mandate from the South African people. And unfortunately, what that means is we may be forced to actually not vote for the parties that we would typically support. And we might actually have to say, look, for the greater good, we want to give Cyril Ramaphosa the mandate so that he can ultimately lead and clear the decks of, let's say, what's been going wrong in this country for so long.
Yeah, we sat around a braai in a place called Claremont in the Eastern Cape just last week, myself, Sumesh, and a few other people from Investec Asset Management. And what struck me was the enthusiasm that even I picked up. I mean, I'm a political agnostic, but the differing views, and it's going to be a fascinating, fascinating election. That's not fascinating, though, is it? I mean, unless you're a real pervert, that is a horrible situation.
It is a horrible situation. And you know, Sanjeev was joking about 400 billion of debt, but it's actually a lot worse than that. And I don't mean financially, I mean in terms of the operations of Eskom. Because an inability to spend money or an inappropriate spend of money has actually meant that they've become operationally very poor. And we experienced it a couple of weeks ago with the load shedding. I mean, I think there was only about 40 or 50% capacity in the system because so many unintended shutdowns occurred at exactly the same time. The good thing, Lindsay, is that government for the first time, if you think about the budget that we just had a few weeks ago, is taking its head out of the sand and addressing it head on. And I think that'll also be very good for the rating agencies. And by saying we're going to allocate 23 billion to Eskom a year, they're at least acknowledging that that problem needs financial support. Also importantly, it's not unconditional. So they are saying there's a plan, we need to see these changes. It's a huge number, but unfortunately, Eskom, from a South African perspective, is that one institution or organization that is too big to fail. I hate using that term, but it really applies to Eskom.
That's absolutely right, and I appreciate the fact that you're, again, the word optimistic, you're optimistic about the fact that they're tackling the problem. But it's like me going to the bank and saying, I'm going to tackle my overdraft, bank manager, but I can't do it because I don't have the means to do so. We've got to find the means to do so.
Correct, and unfortunately that means it's going to come at the cost of wage growth within government. And the reason this is problematic is over the last 7 or 8 years, the only part of the economy that's been creating jobs has been the government. And now they're actually going to rely on natural attrition and early retirement to bring down the wage bill so they can fund ESCOM. So the good news is it's not pie in the sky, let's just raise a lot more debt, let's really get pummeled by global investors off the back of that. They're saying, here's the solution. Government is bloated. They can do with far fewer employees, but obviously that does impact growth in the short term.
And also the election influences that. Let's have a look now at making some money here, because offshore stocks, how many times have we been taking stock? 3 years together, I think it's 4 years
about 3 years. Yeah.
Same slide. Offshore stocks remain our best investment idea. It served you so well.
Yeah, and it's exciting to us exactly because it's so boring to everyone else. And I feel like people are rolling their eyes now when we go, this is the best investment idea. And the response is almost, what's changed? But ultimately, when you look at the prospects for growth, the consistency of growth, that really emerges offshore. I mean, we appreciate that South Africa, as an economy, whether things are good or bad, we're very dependent on resources. We're a mining economy, and the price of resources tends to be very volatile. And so the best opportunities in terms of consistency of return are actually available offshore. And offshore actually gives us exposure to companies that you can't find in the local market, like the sort of companies listed on the right-hand side.
Just briefly tell us about the green versus the blue bar chart, if you would.
Okay, so the bars on the right-hand side of the chart, so it says EV, EBIT, free cash flow. Think about those purely as valuations. So EV, EBIT, similar to PE, free cash flow yield, cash a company is generating. Think about it like a dividend yield. And we're looking at global franchise in the blue bar and the MSCI world in the green bar. So effectively what we're saying in that chart is it's there or thereabouts. Global franchise isn't cheaper or more expensive than the market as a whole. So then you immediately start thinking, well then why can you be so excited about the equity market? Well, that answer starts to build if you look at the bars in the middle. Growth, free cash flow, growth. And offshore, the average market, as indicated by the green bar, is growing their cash over the last 7 years by about 8.5% per annum. The companies that we're able to find offshore are growing their cash by about 10.6% per annum, and that's really important for a South African investor because over the last 7 years, the average company listed in South Africa has only grown its cash by 2% per annum. So you can understand why the local market has struggled the way it has. But the key part of this slide are the bars on the left-hand side, return on invested capital. Now, again, people roll their eyes at me and they go, it's a complicated concept. Think about it like this. We have bonds, and a lot of people have mortgage bonds in this room. And you can sometimes access the cash in them, and sometimes you do access the cash in them to take advantage of an investment opportunity that may come your way. Now, if you're paying 10% on that bond every year, you're not going to access the cash unless the expected return on whatever investment you found is more than 10%. Now, companies have that same cost of capital, and that therefore the return that they generate is very important to them. And so the average company in the world today can find opportunities where they're investing that are yielding 14.8%. That's great. But the companies that we're investing in are actually finding opportunities that are yielding 24.8%. Average South African company is finding opportunities yielding only 7%. And believe it or not, they all have a cost of capital of about that 10%. So South African companies over the last few years have been destroying value. The average company that we're finding has actually been creating a lot of value, and that's what actually creates those massive compound returns that you see in businesses like Visa and
Well, let's talk about the business, because I love examples in order to explain something that I find quite complicated. Have a look at the companies on the right-hand side there. Visa, I used last night at the Sandton Hotel because I bumped into a well-known local billionaire, and we hadn't seen each other for years, and we'd actually become friends a few years ago, but we drifted apart. And I get to the end of the evening, of course, and this happens to him. He's going, "Oh, Lindsay, I'm terribly sorry, this is embarrassing. I can't find my wallet." So the reason he's a billionaire, of course, is because that sort of thing. But I use my Visa. I used my Visa card. Lovely fellow. Microsoft I use every single day. Moody's, we know about Johnson & Johnson. I used one of their products last night as well after the drink for reasons that need not detain us. So let's go straight on to ASML, which is a company that's based in Eindhoven. It's listed on the Dutch stock market. And Eindhoven is old tech because it's Philips. Now it's new tech.
Now it's new tech. So you're right. So you used all those products, barring Moody's. And if we go around this room, you know, if I interrogate all the products that you're carrying with you tonight, everyone would have something from all of those companies except Johnson & Johnson, including ASML, effectively. So we like businesses that are relatively independent of the economy. In other words, irrespective of what the economy is doing, day in and day out, you would expect them to generate reasonable results. And off the back of that, you know, if you think about the value size that a company sells, you can understand what we're getting at. Think about a business like Colgate, and think about a business like Daimler-Benz. You have a 20 Rand tube of toothpaste, you have a 500,000 Rand car. And you get a pretty good idea pretty quickly, you know, which product is going to be continued to be purchased when economies actually turn down. And amazingly enough, the same applies to ASML, but in a very different way. So we're all aware that microchips on the rise, computer chips basically on the rise, because we all want smartphones, we still use our laptops, we love iPads. Now it turns out we have a folding phone, I believe, that's going to convert into a pad, coming from Samsung very soon. And all of these need chips. And of course, these products are affected by the economy. So chip demand goes up and down. And you saw a massive collapse in this chip demand at the back end of last year. But there's this business called ASML, as you've said, that doesn't manufacture chips. Because they said, okay, you know, demand is uncertain. It's ultimately going to be a commodity. Let's not manufacture the chips. Let's manufacture the photolithography machine that uses lasers, that cuts the architecture, that etches the architecture into each of those chips. Because you don't have very many producers of this in the world. In fact, ASML is the only producer of a certain type of machine, and it's high intellectual property. To give you an example of intellectual property, they have these mirrors, 70 square meter mirrors, that focus the lasers. But these mirrors have to be so highly polished. If you blow those mirrors up to the size of Germany, and you were to walk across it, the imperfection on the mirror can only vary by 1 millimeter. So imagine crossing Germany, and surface only fluctuates by 1 millimeter. So it's high intellectual property there. These machines cost $100 million US. Chip manufacturers have to have them. They have to have them serviced. They have to keep up these service contracts. And irrespective of what the economy is doing, you know chip demand is going to go up. You're worried about it in the short term, but ultimately ASML continues to make money. So these boring companies really excite us.
And they served you well, and they will continue to do so, and we'll expand upon that if we can later. But just to end this, pricing power, I've scribbled down here, pricing power, market domination, as you said, there's nobody else that does this with ASML, and barriers to entry.
Very much so.
Key points, okay. Next one, Sumesh has always declined my invitation to comment upon this because he's far too modest a fellow. But what this says is that the strategy that you've just heard about pertaining to the companies that Investec Asset Management likes has served the Investec Global Franchise Fund well because it is an outperformer. You would agree?
I'd agree.
Okay. There you go. Now, here's a seismic looking representation of what you've been doing. And I just want to start with the blue bit at the bottom because that's what I understand. You've been disinvesting percentage-wise in SA equities. That's the sloping nature of that bottom blue block.
Correct. So what you're looking at is for the Opportunity Fund. So this exists for the Cautious Managed Fund as well, and both these funds obviously use global franchise that we've been talking about. You're looking at the history of the asset allocation. In this case, it goes back to 2001. And Lindsay, you're 100% right. We have been decreasing that blue area, local equities, since, effectively 2002. But really, that decrease has really started since about 2000.
But the real story here is that your best idea, one of your best ideas, still remains offshore. A new contender to that crown has emerged from the shadows. Local bonds.
Local bonds. So the orange and the red area, one of our best ideas. In fact, it's probably one of the best ideas in the context of what we're trying to do. So if you think about bonds today, South African government bonds, it's almost a swear word in fund management. No one wants to lend the money to South African government. But as South African investors, the South African government is truly risk-free. They're not going to default for South Africans. Yes, foreign investors get worried because the rand can depreciate and they get less back in dollars, but we as South Africans get back exactly what we put in terms of rands. They own the printing press. But importantly, the shenanigans that happened around 2015, December 2015, Nenegate, ultimately pushed our bond yields out to South Africans, and foreigners became quite disillusioned by what was going on. And now we're in a very exciting place where you can get 5% real, guaranteed if you're a South African investor, 5% real out of bonds, because inflation is currently at 4%. We think it'll drift up to about 5%, so you'll get slightly less.
Just before you do, why would you say that when PPI came out last week, producer price inflation, which was the leader of CPI, and it came out at 4.1%, suggesting that maybe we'll even break 4% at some stage in the next few months?
We could well, because the problem with inflation ultimately is it's an indication of the pricing power that institutions have in the economy. So with the retailers all going on sale before Christmas, almost a month before Christmas, that suggests that they don't actually have any pricing power. The consumer's in a lot of trouble. So ultimately you could see lower CPI, but if we want to be prudent in the construction of portfolios, and with the Reserve Bank targeting inflation of 4.5%, we've got to say a 5% expectation is more prudent than a 3.5% expectation. But this is also important because, as you say, if CPI continues to decline, interest rates in South Africa are far too high at 6.75%. And that's what worries me, because a lot of investors are looking back at what's happened over the last 5 years. The graph that Lindsay put up, and they've said cash has beaten equities. And actually from this point on, cash is going to be one of the worst investments. The grey shaded area on this graph is actually cash in the fund. And we've been decreasing cash.
I can't even see the corner of that now because it's so little. It must be your lowest cash allocation for many, many years.
Ever? No, actually not quite ever, because that was November 2017. It looks slightly lower. But we're talking about 10% approximately in the opportunity fund right now. And bonds, cash is giving you 6.75, maybe 7.2 in money market. Bonds are giving you about 9.3%. And the most exciting part about this is adding South African bonds to the portfolio actually de-risks the portfolio. And it's important because typically the rand depreciates, you do very well on the global component. In addition to the equity returns, you get the driver from the rand, and bonds do poorly. But if the rand were to appreciate, South Africans are such bears, people laugh you out the room if you say, look, the rand could appreciate. But if the rand were to appreciate, there are very few investors that have something in their portfolio that will actually stabilize that negative return. They're getting off a strengthening rand.
So you're getting
bonds do that.
A partial hedge against the offshore component as well of your portfolios.
Exactly right. And so you're reducing the risk in the portfolio while simultaneously actually increasing the return because it's a better return than cash.
This one still baffles me. I've seen this 6 times, I still don't get it, but Sumesh is very, very good at explaining it to clever people. So just briefly, what is that saying?
So back in 2014, we started getting worried about what was going on. 2014, such a long time ago, but it was a blissful period. Let's say the 10 years leading up to it, you were getting 25% out of property on average. You were getting 20% out of equities, and you see them on the high end there. And SA cash and SA bonds were delivering between 7 and 9%, depending on the exact year you looked at them. And we looked at these numbers, and given how quickly prices have run away in the property market and the equity market, and given the state of the economy, especially what we saw going on with the previous president, we were very worried about the sustainability of those prices. And so we said to clients, over the next 10 years, there's going to be convergence. Prices have run far ahead of earnings growth, and as a result of that, you're going to see prices come in. But we thought it would happen over 10 years. We thought it would be a very soft landing within all portfolios. What we did not forecast, Lindsay, was how aggressive the change would be. And ultimately what we forecast has happened in 5 years instead of 10 years. If something happens at twice the rate, you can imagine that it's happened and caused a lot of pain for investors, which is what we've all experienced. The good news, though, is that because it's happened so fast, because the markets have adjusted, not corrected, but adjusted so quickly, the valuations, as you suggested up front, are looking a lot more attractive. and with the risks dissipating, because the biggest issue, and we didn't get to talk about it on the first slide, but the biggest issue is for the last 4 years, you've had a Fed that's been tightening, and in an environment that's been so risky, a tightening Fed creates even more risk. But the Fed's gone on hold. It's acknowledged risks. It thinks it might have over-tightened. And so you have better valuations and a more supportive monetary policy.
And hence the V-shaped recovery that we spoke of earlier on in December. Let's have a look at this now. Green shoots. When I see green shoots, I think of hope. Norman Lamont, the Chancellor of the UK Exchequer back in 1991, first coined it, and Bernanke took up the challenge and mentioned it on CBS News when talking about the US economy. But those vulnerable, pretty little plants, tell me, is that one metaphorical rainstorm or frost or something can wipe out the green shoots. Let's have a look at the green shoots of opportunity in a more scientific way. I don't get as excited as you about this, because that tells me, it could go lower, it could go higher when it comes to the forward PE multiple. But you don't share my cynicism.
No, I think I can be a very cynical person, but there's a difference on this graph for once. You're right. You look at this graph in isolation and you think, okay, the blue line in the end, it's touching the average line through time, but ultimately you can go as low as you saw in 2008. But something's different this time. And what's different is that people are more aware of the risks. Back in 2007, you had crazy investment bankers saying, keep dancing until the music stops playing. You had a Fed that was sitting at 5% interest rates, and people were just willing to gear up to get a piece of what was going on in the markets. Go-go times. People are far more conservative as investors today. I think there's a far greater appreciation of risks, and those risks are very much staring you in the face. But also importantly, the Fed is far more supportive of the market environment. The Fed became very supportive in that kind of pullback period that you see, the kind of pullback period, the GFC. But that's a different environment today. So yes, it could go lower, but the liquidity in the world today suggests that you'll find far more support than you did 10 years ago.
You know what you just said, don't you? Something's different this time. There's a whole graveyard.
Wait, did I actually say that?
Financial services.
Okay, I take that back. It's not different this time. There's a greater... God, it still sounds like it's different this time. But I don't mean that. I mean there's a greater appreciation of risks and a more supportive environment.
Look at the repo rate. We had a GDP print today from the South African economy, which showed a 1.4% quarter-on-quarter increase, and for the 2018 we managed 0.8%, slightly better than the consensus of 0.7%. Put that all together with all the other things we've been saying about inflation, these rates have got to come down pretty sharpish.
They have to come down, especially given the state of the SA consumer. I think the Reserve Bank has gone a little too far. I do think that they really want to emphasize their independence to the global investor base. And I think they want to say that, we are going to hold firm, and they're very clear about the 4.5. But ultimately, with inflation at 4%, rates can come down. The important thing is that real yields in South Africa right now are 2.75%. Sanjeet's graph, going back to 1900, says that real yields on average are 1% when you think about cash. So from our perspective, cash is probably going to be the worst returning instrument over the next 5 years. Yes, there will be volatility. We've discussed this a number of times. But investors who are buying cash today are considering what's happened over the last 5 years, as they did 5 years ago when they thought, what should I be holding today? And they looked at those huge returns that they generated from 2010. So you could be very careful. This could be, long-term, the most value-destructive investment, ultimately, from a real perspective.
Well, let's talk about value creation now, because the last graph, and probably the most dramatic from my point of view, expected annualized returns over 5 years. Neck and neck between SA equities and offshore equity. First time for many years that could have been said.
Yeah, this really excites us, because again, for the last 5 or 6 years, we've been coming out and we're saying, you're not going to make the returns that you do offshore locally. Offshore gives you far higher returns. Now, offshore is still the best investment opportunity. As I said, less volatility, better consistency of growth. SA is a local economy the local SA economy obviously has a lot more volatility because of the commodities. But for the first time in a long time, we're seeing equal returns emerging. And what's exciting for us is over the next 5 years, we're saying you could generate 10% real from these equities. And we're getting excited about sectors that we haven't invested in a long time. So South African retailers, property, even though it has evolved and you need to treat it somewhat differently. General industrials in South Africa, and even financials, which we've had very little exposure to over the last 5 or 6 years.
So it's not the case as if in March 2009 anyone could have just bought anything because the market was in freefall and made money over the next 5 years. You're saying that you still have to be selective and still have to be guarded in your optimism.
Correct, because the point I forgot to make actually about that all-share PE is while it looks like it's just trading on the average line, it's fair. There are a lot of sectors that are still quite expensive, and there are a lot of sectors, the ones that I mentioned, SA-specific sectors that are down and out, and that's what's pulled it down. So if you just buy the market as a whole, you're not going to get that 15%. It's really focusing on those opportunities that are coming to the fore, and surprisingly, even some of the global businesses that are listed locally that were completely beaten up last year are showing incredible value.
Yeah, of course, that was when an investment management company, an asset manager, earns its salt because of the. I'm blowing the trumpet of my employer here, but it is the case. You can't just go out and buy this thing. There has to be some really, really assiduous stock picking from people like Sumesh. Sumesh, much as we'd love to think that we're fascinating, we're not that fascinating. We're just the support act, because the next person who's going to come on stage is called Jeremy Gardner. He's a director of Investec Asset Management, and he is, the word legend is overused in all sorts of spheres, but I think we can genuinely say that Jeremy is a legend, and I can definitely say that his taking stock presentation over the years has gathered momentum and has become legendary in its own right. So please give a warm round of applause to Sumesh and also to Jeremy, who's joining us now.